So the White House likes to tout a number of roughly 12 million jobs created during the Biden administration, even as Republicans say these are jobs that are just being added back after the C-19 pandemic. So basically, tomato, tomato. And to Federal Reserve Chair Jerome Powell's distaste, overall, U.S. hiring grew in February by more than expected, as the labor market remains surprisingly resilient in the face of rising interest rates and higher inflation. And while Mr. Biden was recently discussing the latest February jobs report, he said something that was extremely shocking and terribly hilarious at the same time. Quote, "We've created over 300,000 new jobs last month," according to President Joe Biden, adding, "and that's on top of the 500,000 jobs we added the month before." And according to what Mr. Biden told the press, Biden then continued on to say that means overall we've created more jobs in 2 years than any other administration has created in 4 years. Well, I must say that is quite the accomplishment, Joe. And although what Joe had to say next was quite possibly the most impressive bit of information, in that, all told, we've created more than 12,000 jobs since I took office, nearly 8,000 of them manufacturing jobs. Come on, Joe. That is far from any real accomplishment worth bragging about. Now, obviously, President Biden accidentally undersold his own administration after making a gaffe during the February jobs report, but it was funny to say the least. Now, I'm not sure if he misspoke or read the teleprompter wrong or if his copywriter made a mistake, but I bet in the future when OpenAI and ChatGPT begins to write the president's scripts, they will be far more accurate. Well, that is all depending on where AI pulls their information from and which narrative wants to be pushed to mislead the people. But in all actuality, employers added 311,000 jobs in February, according to the Labor Department, and what was said in its monthly payroll report released Friday. Numbers easily topping the 205,000 jobs previously forecasted by Refinitiv economists. And so it marked the second straight month of hotter than expected job data, after the economy added 504,000 positions in January alone, a total that was revised down from the initially reported 517,000. Meanwhile, the unemployment rate unexpectedly ticked higher to 3.6% as the labor force grew, which tells us all something and a very clear message about employment right now. And the monthly jobs data is very important, especially right now, as the Federal Reserve is closely watching this particular report for signs that may suggest the labor market is finally softening and that the blowout figures in January were an anomaly as policymakers try to cool the inflation with even higher interest rates. What do you all think? Comment down below, let me know. And after reviewing what some would suggest as metrics that can be used as a decent gauge or indicator of the strength of the U.S. economy, sees tragic signs of weakness and the possibility of big problems heading our way. Now, when the U.S. Bureau of Labor Statistics posted job growth that was meaningfully below the 500,000 increase expected, markets rallied temporarily the following morning. But this proved to be a short-lived rally that repeated the trading pattern from the previous day before. Hours after the jobs report, the Federal Deposit Insurance Corporation, the FDIC, announced that it would shut down Silicon Valley Bank, or SVB for short. And the seemingly separate incident from the jobs report is highly connected, as the Federal Reserve will need to weigh in on the strong jobs report, its hawkish or tightening interest rate policy, and its effect on regional banks. Meanwhile, the jobs increase that we all saw in February 2023 as the economy added 311,000 jobs and the unemployment rate edged up to 3.6% was just a likely addition after an expected decline from January. Now, it is also less than half the jobs added a year ago for comparison's sake. And it is also important to point out that last year, the central bank did not raise interest rates as economic activity accelerated. So job growth slowed considerably last March and April, only to hover around the 300,000 level. And so last month, when jobs grew the most in leisure and hospitality, retail, trade, government, and healthcare, and while employment fell in the information, transportation, and warehousing industries overall, this showed us something very, very important, because FreightWaves just reported that the third biggest decline in truck transportation jobs in the last decade. And outside of the big drop when the pandemic began, February's decrease was the largest going all the way back to 2013. The job losses suffered by the truck transportation sector in February have almost no precedent in the last 10 years, except for the massive drop in April 2020 and a similar drop almost 10 years ago. And the Bureau of Labor Statistics data reported Friday showed that the truck transportation sector saw a decline of 8,500 jobs in February, coming in at just under 1.6 million on a seasonally adjusted basis. And so, the end result is that on a seasonally adjusted basis, the industry was told in early February that in January it had 1,604,700 jobs in the truck transportation sector. And now, with the adjustment of the January numbers and the drop in February, it is looking at a job total that is 14,800 less than that, with non-seasonally adjusted truck transportation jobs also seeing a downward move, dropping 10,600 jobs to 1,575,800 jobs in February. And so other data points in this month's BLS report include these bombshells as well. Warehouse jobs are also on the decline, and on a seasonally adjusted basis, jobs in that sector in February stood at 1,929,400, down from 1,934,900 a month earlier. And rail jobs look like they were on the upswing, and maybe they are with just a 1 month blip, but pressure to increase the ranks of workers has only grown with the East Palestine, Ohio derailment in early February, yet jobs dropped 200 in the rail sector to 148,900. And David Spencer, the vice president of market intelligence at Arrive Logistics, said the drop in jobs is coming alongside signals that trucking companies are getting from the market. The jobs decline is driven by the results carriers are seeing in this year's current RFP season. And in an email to FreightWaves, Spencer said, with shippers lowering volume expectations, carriers will be providing smaller commitments, which means the same way that spot rates are starting to bottom out, we're going to see jobs continue to decrease over the next few months. And he said there were other indicators of the weakness in the market that are ongoing or should be watched closely, such as used equipment prices declining and a slide in contract rates. And I quote, while many carriers were holding out hope for a recovery, Spencer said, I believe now we are seeing carriers adjusting to the new conditions with more confidence, end quote. Hopefully you all are preparing for what is happening and all that is headed our way and taking advantage of the opportunities now to get invested and most importantly, diversify like I have and making sure that you and your family are secure and continuing to produce multiple streams of cash flow just in case. Because folks, you just never know what will happen next. Remember, 100% free links in the description down below. I'll see you guys on the next one. Take care. Bye.